The IRS starts at yes. You have to prove the no. In this video, you'll learn what this rule really means, the 3 income buckets the IRS tracks, and the key exceptions that are truly tax-free. Let's dive in. Here's the legal backbone. IRC Section 61A says, gross income means all income from whatever source derived, unless the law says otherwise. Plainly put, whenever cash hits your pocket, be it a paycheck, weekend gig earnings, or profit from selling Bitcoin, the IRS treats it as taxable income. It's tax-free only when a specific code section says so. Now that you know the default is taxable, the next question is how the IRS sorts all that money. It drops every dollar into one of 3 buckets. Let's break them down. Bucket 1 is earned income, money you grind for. Think W-2 paychecks, tips, or those DoorDash payouts. Still with me? Let's pause for a second and watch this hummingbird hover around some flowers. Let's dive back in. If you're a W-2 employee, 7.65% is taken out for Social Security and Medicare, plus federal income tax and state tax if your state has one. If you're self-employed, you pay the full 15.3% for Social Security and Medicare yourself, plus federal and state income taxes when you file. And if you want a full breakdown of every tax that gets pulled from your paycheck, I've got another video just for that. I'll drop the link in the description below. Bottom line, anytime you trade time or talent for dollars, it lands in Bucket 1. Bucket 2 is investment or passive income, money your money makes for you. That includes interest from a savings account, stock dividends, rental income, or profits from selling Bitcoin. Here are 2 key tax angles to know. If you sell an asset, like stocks or crypto, after holding it for more than a year, you may qualify for long-term capital gains tax, which ranges from 0 to 20%, depending on your income. Sell it after holding for less than a year? That's a short-term gain, taxed at your ordinary income tax rate, which could go as high as 37%. Let's take a brief pause to watch this majestic lion engulfed in flames. Okay, let's jump back in. Other passive income, like bank interest or dividends, is taxed the year you receive it at your ordinary income tax rate, typically between 10 and 37%. If the dollars show up while you're sleeping, chances are they belong in Bucket 2. Bucket 3 is windfall income, the money that just shows up. Think a surprise lottery win, an unemployment check, or a canceled credit card balance. The IRS still taxes most of these, even if they feel like one-offs. Unemployment benefits are taxed just like regular income. Depending on your bracket, you could owe anywhere from 10 to 37%, and many people don't have taxes withheld up front. Canceled debt can sneak up on you. Say you owed $5,000 on a credit card, but you settled for $1,000. The forgiven $4,000? The IRS sees that as income, unless you were insolvent at the time. Prize winnings like cash, vacations, or even a brand new flat screen are taxed at fair market value and counted as income. That free prize? It might come with a tax bill. If it isn't wages you worked for or profit your money earned, it parks in Bucket 3 unless the code says otherwise. So now you've seen how the IRS handles earned income, investment income, and even those random windfalls. And by default, every dollar gets taxed, unless Congress carves out a specific exception. So let's flip the script. Here are the rare cases where the IRS actually says you can keep the whole thing. These are the true tax-free wins. If someone gives you money out of generosity, no work, no strings attached, you don't owe income tax. In 2025, up to $19,000 per person is completely tax-free to the recipient. The only catch? The giver may need to file a gift tax return if they give more than that, but you don't report a thing. And if you're married, you can give an unlimited amount to your spouse. No tax, no limits, no reporting required. Most of the time, money or property you inherit is not taxed as income. Whether it's a check for $10,000 or a home worth $1 million, the IRS doesn't count the inheritance itself as taxable income. But retirement accounts are the exception. Traditional IRAs and 401ks are funded with pre-tax dollars. If you inherit one, you'll owe income tax on any money you withdraw. And unless you're the spouse, you're generally required to empty the account within 10 years under the current rules. Roth IRAs and 401ks are funded with after-tax dollars. Withdrawals are tax-free, but only if the account's been open for at least 5 years. If it hasn't, the earnings could be taxed. And like traditional accounts, non-spouse beneficiaries still have to empty the account within 10 years. Let's take a moment to admire this baby calf and their fluffy ears. All right, ready to jump back in? If someone leaves you money through a life insurance policy, the death benefit is tax-free, no matter the amount. Whether it's $50,000 or $500,000, you won't owe a dime in taxes on that payout. The only catch? If the policy earns interest before it's paid out, that interest is taxable. So if you receive the benefit in installments, you'll only pay tax on the interest, not the original payout. Scholarship money can be tax-free, but only if it's used for the right things. Use it for tuition, fees, books, or required supplies, and you won't owe a cent in tax. But if you use any portion of it on room and board, travel, or optional equipment, that part becomes taxable income. Let's say you receive a $10,000 scholarship. You use $7,000 for tuition and books. That part is tax-free. But the other $3,000 goes toward campus housing. That piece gets taxed. So the scholarship itself isn't always tax-free. It all depends on how the money is spent. If you get a legal settlement for a physical injury or illness, that money is tax-free. So if you win a case for a car accident or medical harm, you won't pay taxes on the payout. But not all settlement money is treated the same. If the payout includes money for lost wages, emotional distress, or punitive damages, that portion is taxable. In short, if the settlement is compensating you for actual physical harm, it's usually tax-free. Everything else? The IRS wants its cut. If this helped make taxable income a little less confusing, hit like and subscribe. It really helps us out with the YouTube algorithm. Here's everything we've covered. The IRS puts your income into 3 buckets. Earned income, money you work for, like paychecks, tips, and freelance gigs. Investment income, money your money earns, like interest, dividends, and capital gains. Windfall income, money that just shows up, like unemployment checks, prize winnings, or canceled debt. Unless the tax code makes a clear exception, all of it is considered taxable income. There are a few true tax-free exceptions, like gifts, inheritances, life insurance payouts, qualified scholarships, and certain legal settlements. Everything else? The IRS counts it as income and expects you to report it.